It doesn't matter how much equity, quote unquote, you think you have. In the end, equity can erode and cash flow certainly can erode, but if you have enough margin, it's really hard to get rid of it. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, welcome back to the show. I'm your host, Todd Dexheimer, and I want to talk about DSCR. I hope you're doing well. Summer's been going really fast. We're into Q3. Man, we're already a month into Q3. Jeez, already a month into Q3. We're sending out distributions and stuff like that right now and getting all our reports out. But I want to talk about debt service coverage ratio, talk about getting loans. And when we're talking about getting loans on any kind of property, any kind of investment property, it's really important to consider a few things. And so the things that probably the thing that most people talk about is that LTV, or loan to value. And people brag about getting either a really high loan to value or a really low loan to value. And so, the loan's going to really affect you. If you're getting a loan, it's going to affect your cash flow and it's going to affect your returns. So here's the thing. If you got no loan, obviously then it's just your income minus your regular expenses, and that's your cash flow. But your cash flow is going to be fairly low because you've got no leverage. And obviously your down payment is going to be really high because it's the purchase of the property. So if you're buying a $20 million property, boy, that's a pretty big purchase, right? You got to come up with $20, $30 million if you got some capital expenditures, but you got to come up with a lot of money. But let's say you're buying that same property for $20 million and you can get by with an 80% loan to value. So just a 20% down payment. So that 20% down payment that you have to put down now, that's only going to be $4 million. If you could get by with a 10%, you'd only have to put $2 million on it. And that's a great thing, right? Well, seemingly. Talk a little bit about why that might not be. But instead of 20% down payment, a lot of people want to put down more, and we want low LTV, low loan to value. And that's actually, I would say, for the most part, a good thing, right? You're trying to be conservative. You're not trying to over leverage the property, but sometimes it's still not that conservative. And we'll talk about why that is. But instead of doing this 20% down payment, maybe you're doing a 40% or even a 50% down payment. And so if we're doing this 40% down payment instead of a $4 million payment, now what we got to do is put down 40%. So we're putting down an $8 million down payment. And now if we have some repairs and some reserves that we have to put to the side, we might have to come up with, 10, 12, even $15 million, depending on what kind of repairs or renovations that we're going to do to the property, right? There's also the case where you can potentially fund those renovations. But again, that can be more risky. And so we have to be careful about how much risk we put on the table when we're buying these properties. So what I want to focus on, though, is why I think loan to value is way overthought, way overplayed. I want to talk about LTV. I want to talk about DSCR, debt service coverage ratio, and why, in my opinion, that's the most important metric when you're making lending decisions. When you're making decisions on what type of loan to get, what is your DSCR? DSCR over the years, not just day one, but DSCR day one, DSCR, day 365, DSCR 5 years from now, 10 years from now, however long you're going to keep the company, keep the property going. So what's DSCR? DSCR is simply taking the net operating income, so your income minus your expenses, so the net operating income, and dividing that by the mortgage payment. So it's a ratio, and it's saying how much money you're making. So it's basically telling you your margin on your net income based on the loan amount, based on the mortgage payment that you have to make. The higher the DSCR, the more margin you have, meaning the more safety that you have, meaning the safer that loan is with much, much less risk as I get higher and higher and higher. Now, most lenders are going to require a DSCR of about 1.2 to 1.25. Depends on the type of lender. Fannie, Freddie, okay, agency, more conservative, it's going to be 125, maybe even 130. And a less conservative underwriter, like maybe a local bank, is probably a little bit less conservative. They might be at 1.2. And then you can always get loans that are actually even zero DSCR or negative, potentially even DSCR, where we're talking a big renovation loan, a bridge type loan. And so we can get under 1.0 debt service coverage ratio. Now, if I have a 1.0 debt service coverage ratio, what that means is you are breaking even. So that means that my mortgage payment is $50,000 a month and my net operating income is $50,000 a month. Simple as that, right? And if I've got it below 1.0, it just simply means that my net operating income, the cash that I'm bringing in, won't even pay for the mortgage. I've got to somehow come up with more cash, whether that's reserves, whether it's out of my own pocket, whatever that might be. Now, again, the bank at a 1.25 is going to say, so if we have a $50,000 mortgage, then I need to multiply that by 1.25, and I need to have a net operating income of 62,500. So I need to be able to cover that. And you can see we only have $12,500 in cash flow. So we have a very tight margin. What I like to see is debt service coverage ratios that far exceed that. And I really want to see 1.5 or higher. My goal is to see higher than that, but kind of 1.5 is a really good metric, in my opinion. That starts to give us a little bit of safety cushion. When we think about any company and their profitability, every company's profitability is based on their cash flow, and their cash flow is based on their margin. And so every company is trying to push their margin to be higher and higher and higher. And when we talk about a penny business, we talk about businesses that have very low margins, right? And most people tell you to avoid those types of businesses. You want to look for businesses that have large margins. And so what I think have forgotten a lot of times in investment real estate is that we need to be looking for what kind of margins do we have. And now we do, when we're looking at income and expenses without the mortgage, we say, oh, yeah, this is going to run at a 50% or a 60%, expense ratio. Okay. Well, oh, great. A 50% means 50% margin. That's a good margin. But now when we add a loan on top of it, what is that actually doing to us? We're no longer 50%. Are we 10%? Are we 5%? Are we 20%? What are we in our true margin? And that's what we got to look at, right? So what I want to see is, I want to see, again, a 1.5 DSCR, meaning if I'm making 50, my cash flow is 75. Right. And that's kind of minimum. I really love seeing a 2.0 or really close to a 2.0, meaning if I got 50 payment, my actual cash flow is $100,000. So that's beautiful, because then I've got a good margin, and things can actually go wrong and I can still cash flow. I can still survive that property. We got a property we bought last year. And when we bought this property last year, there wasn't a ton of meat on the bone still, right? We typically like nice value add properties. Want to see that nice value add that we can bring in some equity or add some equity to it and eventually sell it for a nice profit. But this property had a really strong cash flow. But what was really, really nice about it is we were able to assume a mortgage, and we were able to assume a mortgage with low LTV. And this is kind of like, this is the winner right here. Low LTV. We are below 65% loan to value. And we had a loan that was locked in long-term, has 6 more years left on the life, 30-year amortization, with 2.5 roughly percent interest. Okay. What that does to us is that created a really high DSCR. And so now our DSCR is hovering right around that um, DSCRs, three coverage DSCR. And so when we look at that, our income is three times higher than our mortgage payment. Three times higher than our mortgage payment. It's not just double, it's three times higher than our mortgage payment. That for us is really huge. And when we look at it, we say, well, even though there's not a ton of value add, there's still some efficiencies we can gain. There's still some rent growth that we can have, and we can push this property to a 4 DSCR over the next couple of years. And that means we've got 4 times the net operating income that we do the mortgage payment. A lot of things have to go wrong with that property. The other thing is, like I said, we are under a 65% loan to value, actually loan to purchase, right? You could call the value higher, you could call the value lower, but loan to purchase is, and that's what we always based on, because obviously it gets an appraisal and all that kind of stuff. But that gives us a safety net too. And so it really created a positive story for that property. And it's held true, is that we've got really strong cash flow with low leverage. Those are the two things I really want to look for. Now, here's what I want to talk about to make sure you understand why sometimes I would rather have, I would take, if you're to give me 2 properties, if you're saying, hey, which one do you want? Okay. You got to pay the same. Your down payment's going to be the same, or whatever. The price is going to be the same, all this kind of stuff. It's good. But here's seemingly on the outside, as I underwrite these, they look like they're both going to be a 16 IRR to your investors. But this deal over here is a 65%, 60%, let's go 60%, 60% LTV, right? And it's a 1.25 debt service coverage ratio. So 60%, 1.25. But this deal over here is going to be 75% LTV. 75% LTV. Some people are going, well, that's not very conservative. 60% is much more conservative. That seems like a way better deal than 75. Now you're putting a lot of risk on that deal. But if I were to tell you, but at 75%, the debt service coverage ratio is 1.75. Which deal are you going to pick? I'm going to pick the 75% LTV all day long, because I know my debt service coverage ratio is really nice. My DSCR is at 175. Now, that's not taking into account all the other various things that might be happening with that property. But to me, that's more important. So I would rather have the margin on the cash flow than the margin on the equity. Much rather. What I've learned through the years, and I feel like I've always known this, but maybe have ebbed and flowed on kind of how I think about it. But in my opinion, cash flow is so much more valuable than equity. Equity is something you can pump your chest about and go, oh, my net worth is this. And it's cute and it's great. And congratulations, by the way, for building a high net worth. I think that's awesome. And I want you to, and I want to as well. However, that doesn't pay the bills. That doesn't do anything for your current lifestyle that you're living today. And I don't want to live a lavish lifestyle. That's just not who I am. Like, I'm probably never going to live a lavish lifestyle. However, your cash flow allows you to survive. Your cash flow gives you cushion. Your cash flow gives you safety. And so I think it's so much more important to focus not on the equity you're building, but on the cash flow you're creating. And that's the DSCR that's, to me, that serves you so well, is when we have this high DSCR and we get really good margin with really good cash flow, we've protected our downside. And so now it doesn't matter when that next recession happens, our property has enough margin where we can survive crap going on, right? We can survive issues happening. And we don't have to worry about whether we can make it through the next cycle. And that's what's happening right now, right? There's a lot of people that are having a tough time making it with their current properties. and they're wondering, can they make it through until this cycle ends? And will the cycle go up fast enough where they can actually get out ahead? Not sure, right? Because they didn't focus on DSCR, because they only focused on they focused on other metrics, whatever they might be, but they didn't focus on debt service coverage ratio and thinking about how's that going to affect me in the end. Um, these there's something else that a lot of people, what they'll do is, and I see this a decent amount, is they'll say, well, we're getting a great LTV. We're getting this deal done at 70% or 65% or even 60% LTC, loan to cost. And so what they're doing is they're taking in consideration this construction that they're putting into the property. And this can be good and bad, by the way. It depends on how you're doing it. Overall, we definitely want a better loan to cost, right? We would rather have it more conservative, 50, 60, 70% versus 80, 90%. However, again, I think it still comes down to DSCR. How much are you able to cash flow? And do you have enough margin there? And so what a lot of people do is get this, they'll tell you, well, we're being conservative. We're doing a 65% loan to cost. And so they're buying it for, call it 20 million. They're putting another 5 million into it. So their finance is based on 25 million. However, when you look at their net operating income, the mortgage payment is going to be, it's really high compared to their net operating income. So now they're sitting here at a 1.1, a 1.05, maybe less than 1. And the lender says, okay, because they've got this business plan, and the business plan says that they'll be able to cash flow eventually when they complete it. However, you're taking some risk, right? You're taking some risk, and we don't know if that's truly going to be the case. Now, am I willing to take that risk? Sometimes I am, right? But it depends. Well, first of all, it depends on the type of loan. I think bridge loans are garbage. I think nobody should be doing them, quite frankly. We've done them before, and I've learned from that mistake, and I will never do a bridge loan again. I just don't think they're a good product for any, I shouldn't say any situation. Very rare case, I think bridge loans are acceptable. I would say the vast majority of the time, they are a terrible loan for anybody to get into. The loan product is very risky, and it's just not worth it, really, honestly. I know for me, we just are really apprehensive about doing anything with a bridge loan. And as an investor, I would probably 99.9% of the time say, no way, you get a bridge loan. It doesn't make sense. And most people are putting bridge loans on deals. It just doesn't make sense to do it. Like, this thing's already 85 to 95% occupied. You're going to, stick $20,000 a unit into it. Like that's not a case for a bridge loan. Where a case for a bridge loan is you've got a property that is, 40% occupied, 30% occupied. You're going to stick 40,000 a unit into it. That might be a case for it, right? That might be a case for it. Quite frankly, that might be better served just to do cash, just to buy that whole thing cash, renovate it, and then finance it after the case. That would likely be the better play in the end than the bridge loan. But that's maybe your base for it. But let's get back to it. We try to sometimes get too cute and talk about our loan to value, but it doesn't matter how much equity, quote unquote, you think you have. In the end, equity can erode, and cash flow certainly can erode, but if you have enough margin, it's really hard to get rid of it. And again, I'm talking true cash flow, by the way. I'm not talking like made up cash flow or cash flow that you think you might be able to get it eventually in the future. Now that I want, right? I want to have that. I want to have cash flow that I can get in the future. But what's the cash flow today? What's the DSCR today? We certainly want to look at that. And again, there's the case for high loan to value. Look, if I've got a property that's got great cash flow coming in. And somehow I swung an excellent deal on this property. And I can somehow get into it between maybe it's a seller finance deal. Maybe it's a seller carryback with the bank, and they're willing to do it, and we can get in this thing for 5 or 10% down, and the cash flow works really well. We've got a DSCR that's 1.5 or better. Like, yeah, that might make sense. That deal is not, in my opinion, it's not that unattractive if it's got some value add to it. Like if you're coming in with the DSCR that's 1.5 on that deal, and you got to put 10% down, and you're just, and most people are going to go, oh man, your LTV is way too high. But if there's a little bit of value add there, and we can create some equity, but we've got really strong cash flow, that deal could work. So, all right. That's really what I wanted to talk about. I just protect your cash flow, understand what it is, and protect it. And it's so much more important, in my opinion, than equity. Equity is great, but equity doesn't pay the bills in the end. Debt service coverage ratio means so much more. Look, when I was building my rental portfolio, I built my rental portfolio, and I had a ton of equity sitting in these properties. But what I did, and I could have refinanced and I could have pulled out a bunch of money because I could get 80% loan to value, right? So I got appraisals on a big portion of my properties, and I said, I want to look at the interest rates and the loan terms and all that kind of stuff when I did this refinance. And I said, I'm going to do this refinance, but I'm going to keep all my properties at 1.75 DSCR. So that's the maximum I was willing to go, or the minimum I was willing to do was 175 DSCR. Now I could have pulled out a lot more cash on a lot of properties, and every property had a different LTV. Some properties LTV were 78%, and other properties LTV were 50%. But it didn't matter to me what the LTV was as much as it mattered what the actual DSCR was. So that's all I really looked at. Now, I should say all. I definitely looked at the LTV, but for the most part, I was more concerned about what my margin was there. All right, that's all I got for today. Protect your cash flow. You have a fantastic rest of the day. Make every day Saturday. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.